Hello, hi. My name is Jerry Miller from Trendsignal, the trader education company. And this is part of our Monday Market Insight series, and we're looking at a rather curious topic, the Bank of England's gloomy forecast. For those of you who were around last week, and a lot of us are on our summer vacations at this time of the year, but the Bank of England really did surprise the markets with some pretty dire forecasts of what's going to happen here in the UK, and it's changed significantly from their last update in May, which was the real surprise. The main elements of the forecast you can see on the screen here: inflation to hit 13.3%. So back in May, they predicted that inflation would touch 10% sometime late this year. But now they're predicting 13.3% in the first quarter next year. So anyway, up to the end of March, and that's likely to be the top in terms of their inflation prediction. But they're also saying that the UK is going to experience a recession. And a recession is 2 quarters of negative growth. We actually have GDP data, or which is essentially tells us what growth the economy is experiencing. We've got that out this coming Friday, and there are concerns that actually the second quarter of this year will actually have a negative growth of minus 0.2%. It's only marginal, but it could mean that we're in for a recession that may last anything up to a year and a half. Anyway, their prediction is that it's 5 quarters starting in Q4 this year and taking in all of next year, so all of 2023. Incredibly gloomy, to be honest, but let's just have a look at the graph, see how much it's changed. So this is just a graph from a page from the Financial Times, and it basically tells us what the Bank of England is forecasting over the next 5 quarters. The blue line is their forecast in May. I mean, May, it's not exactly a long time ago, it's 3 months ago, but in that time, they've radically altered their view of the lack of growth here in the UK over the next 5 quarters. So you can see now the August forecast is just poles apart. And obviously, it's their revision of energy price shock, which is still expected to remain very elevated, although we note that crude oil actually is below levels that it was at the start of the Russian invasion of Ukraine. But that's in dollars, crude oil, and in sterling, with sterling having fallen quite sharply against the dollar. It means that oil has not come off in sterling terms anything like as much as in dollar terms. Anyway, let's get back to the slideshow. So the rather destructive effect of inflation is going to be felt for quite some time. And it's quite interesting how the central bank is trying to get its credibility back, having been a little bit late out of the starting blocks. Probably one of the first ones, really, along with the Federal Reserve, but still nothing like enough in terms of rate rises. We're currently at 1.75%. And with inflation running at 9.4% and going higher, the predictions are there's 3 more meetings for the Monetary Policy Committee before the end of the year. We're highly likely to see another 1.25% increase in rates, which basically means out of the 3 meetings, at least 2 half-point rises and another quarter-point rise. So somewhere around 3.25% is the year-end forecast for interest rates. Really, what does that have? What effect does that have? Well, it's got a significant impact on businesses and consumers. Firstly, businesses looking to raise capital. The cost of that capital is going up sharply compared to where we were at the end of last year at plus 0.1% in terms of interest rates. So there's been a huge shift there. For consumers, well, certainly the destructive forces of inflation basically means that unless inflation is brought under control, we're going to see a collapse in real wages of the worst in 60 years. And the recession that they're forecasting will probably be the worst since the early 1990s. For consumers, mortgage rates, everyone knows about mortgage rates. When I was younger, most of it was done on variable rate, but most borrowers these days have fixed rate mortgages that are fixed for sort of 3, 5 years, some longer. But according to data that I've seen, 40% of fixed rate terms are due to expire this year. So it'll expose those borrowers to higher mortgage rates. But going back to other um, implications as well. Obviously, with inflation really, really high, it has a significant impact on the people who can at least afford the effects of this inflation, which is the lower income households, and the jump in the energy cost that's going to happen in October when the new price cap is announced. And that's something that the incoming Tory Prime Minister, whether it be Rishi Sunak or Liz Truss, likely to be Liz Truss, going to have to tackle pretty much immediately. The forecasts for economic growth and inflation here in the UK is just so worse than a lot of the rest of the G7 economies. And I think it's down to the fact that so far the Tory government have not given the sort of help that you've seen provided in a lot of countries in the EU and elsewhere. We have to wait and see when Liz Truss or Rishi Sunak assume the mantle of Prime Minister in on the 5th of September. That's it. Thanks very much.